Good morning and welcome to the Orlando Real Estate Buzz. I'm Brendan Rendo with the Homes in Orlando team at Next Home Neighborhood Realty. Fortunately, Joe Apley Home Loans, our associate who joins us every week, it wasn't able to do that today. But we're going to get into the main item that's really taken all the headlines over the past couple of days, and that's inflation and how that is being as stubborn as it possibly can be. And it really has pushed the Fed back on any possible rate cuts. This morning, we just received the new wholesale price index, the PPI, and that came in actually double of what was expected. They were expecting about 0.3 percentage, and we actually came in at 0.06. So inflation is not hedging. And remember, this is wholesale. And what happens is your wholesale will get eventually passed on to the consumer. So if the wholesale rate is above where it's expected, you can expect over the next couple of months that's going to have continued pressure on the consumer price index. And if that pressure continues, we're not going to see inflation fall. I don't think we're going to see it below 3%, even for the next couple months, maybe possibly 3, 4, 5 months. And that's really putting the Fed in a tough situation as far as balancing act of, do we cut rates? Do we not cut rates? So we've got the PPI, and then earlier this week, we had the consumer price index released as well. And as you can see, that came in at 3.2%. Again, higher than expected. And the core was from two areas. Actually three. One was energy, and everyone can see that. You go to the gas pump over the past couple of weeks here in the Orlando area, you're starting to see gas up around the 330. I've seen it at 345 at several locations. So gas prices are starting to push back up. And then the one that's been extremely stubborn is the shelter, which of course is your rental. And that continues to stay elevated at 0.4 and 5.7% for the past 12 months. And until that rental starts to come down, we're going to continue to see that pressure of the overall inflation number increasing. Those two sectors, the shelter and the energy, actually make up 60% of the total number. So as long as those two are elevated, the inflation is not going to drop. Now they're saying food prices. I don't agree. I'm sure everyone who goes to the grocery store feels the same way. Is that they say food inflation is pretty much leveled off, but every time you go to the store, you see that increasing. And then the other area that is a huge hit, but doesn't have as much weight on the overall inflation number, is our transportation services. And this is one area where Powell has said he wants to see this go down. And currently we're sitting last month at 1.4% or 9.9% over last year. So all these numbers are really forcing the Fed to say, let's wait. And along with the Fed saying, let's wait, Jamie Dimon, who's the head of Chase Bank, the world's largest bank, actually came out this week and said he wants the Fed to delay cuts. He doesn't want them to cut early and cause additional problems, which is interesting because they won't be as hurt as some of these other smaller banks that are out there that, due to the higher interest rates, are having a lot of trouble in the commercial market, as we've discussed several times. So not only do you have Jamie Dimon, but you also have the head of Citadel, which is a large hedge fund, also cautioning the Fed not to cut rates too early. Right now, My guess is we may not see rate cuts until October, November timeframe. March, off the table. They may, I mean, they're going to have a meeting on the 20th, but everyone knows that they're not going to cut. So, and just looking at it, they said they were going to be cautious. They're going to continue to be cautious overall, and they'd rather keep them steady longer. If inflation continues to hold, I think even for the next 2 to 3 months, you may see an additional rate increase. Now, normally, remember, it takes 12 to 18 months for these rates to get through. And our last rate cut was, I believe, June of last year or maybe May of last year. So all the rate cuts have not completely cycled through the system, but we're seeing a lot of hits to the economy. For instance, one of them is the family dollar and Dollar Tree. Well, first off, you can't call anything a dollar anymore because it's not, but they're going to be closing 1,000 stores, which, if you think about it, that hurts the most economically disadvantaged people, families out there who were able to, get items that at this store where at other stores they were paying, 10 times or more what it is. But to see these close, and again, it's all due to the pressure of this inflation overall. So you have that going on. And when we look at our current 10-year treasury, which really kind of is a great indicator for where interest rates are going to be, you can see over the past several months, we've really, besides taking a small dip, we've really stuck in that 4% interest rate, and we're coming back up to where we peaked over the past month and a half, which is around that 4.25. So I think we're going to continue to see this area as where the interest rates are going to fall. We may drop if inflation contained a little bit. We may drop down to that 6.5, but I think we're going to continue to see rates average in that 7% interest rate level. So we're going to continue to have to be creative in the way we structure deals. Builders are going to continue to offer incentives with the buy downs, and you're just going to see the sales numbers continue to be depressed overall. Our inventory is growing, but it's the sales numbers continue to be depressed from where we feel a normal market is. And when we look at where people are betting on where those interest rates are going to go, is right now you can see for March that 99%, I don't know who the 1% is, the 99% say they're not going to cut rates. And then we go into May. This was a huge swing from last week. Last week, we had about 24% that said that they felt that we could get a rate cut in March. Right now, we're down to only 6.2%. And I think depending on the message we get on the 20th from the Fed, I think we're going to see this continue to jump up. And this should probably by the next week be up to around 99%. They're not going to cut in May either. They're not. Inflation is too hot, especially with the numbers that came out today. And if we continue to see job numbers elevated as we have, that's another item to throw on the inflation side of the scale, and the Fed's not gonna cut the rates, because even when we go into June right now, you got about 60% saying that they will cut a quarter of a point, but that's down a little bit. It was around 65% last week, so that's changed a little bit. Something's got to cool the economy off for them to actually do the interest rate cut. So overall, that's really where our biggest item is right now this week in the news is in the inflation number and how it's affecting the Fed overall. We're seeing the detriment of the higher rates. We're seeing it in in store closings. We're starting to see it in job layoffs. But what the Fed really is kind of saying is, well, yeah, we've got some pain, but it's like a scraped knee. Yeah, you got a little bit of pain, but we don't have to amputate the leg yet. So until they feel we felt enough pain, they're not going to cut the rates. And it's going to stagnate. It's just going to continue to stagnate a number of items, the main one being housing. And housing is the biggest lifeline in the economy. And what we're seeing right now, I got a sheet from Lennar Homes for their Tampa area quick move-ins. And there were probably 200 quick move-in homes on their list. It was 6 pages long. So when you're looking right now, one of the best places to look overall is in the brand new home builds because they have to continue to move inventory. And what they're offering overall it's just increased continuously. So that's one area that's a great area. And we've seen prices stay pretty level. And if we hop into our numbers for Orlando this week, we'll see that the overall numbers have held pretty steady because the previous week was 566 units and we came down to 401, which is the first week of the month. So you expect there to be a bigger spread between the first week and the final week when everyone tries to close their homes. And then we see here the median price of the single homes actually decreased 1.3% to $420,000. Well, unlike a lot of other areas, we're not seeing the prices continue to increase. And why is that? Well, one is inventory is starting to grow again. People are being more cautious. And it just comes down to actually just straight out numbers. This is what people can afford. They're not going to go above it. And they're going to wait for those houses to come down. In some areas, I was looking at Longwood area where I currently live. Excuse me. And their average days on market for last month, February, was actually 73 days. So homes are staying longer on the market. Then we see with condos. Condos actually didn't have a bad week where they sold 147 units. But look at the change in the median price. Median price actually came down 6.1% to an average of 263,000. And the inventory peaked up a little bit, 28 units, nothing major. Then when we come into one of the most informational slides that we go through every week, the original to final list price. And you see on average, people are getting about a $13,000 discount. But look at this. We went up a little bit, not too much, but sitting right there at the 95% of original list to sales price. And where are the two biggest areas that you're seeing discounts? Believe it or not, it's under the 250,000 where you're at 93 and the over $1 million, where this actually jumped up about 4 points from last week where it was at 88% and we're sitting at 92%. Those are the two big areas. And with $1 million homes, they're sitting 85 days on average now, but the overall average is about 54. And you see it here graphically when we look at the average and the median value of homes sold. It's really kind of flatlined right around that $500,000 mark. And then you see our weekly sales. So last week was actually a very good week, which we're starting to get into spring. So we should see this pick up a little bit, but still 400 homes on a weekly average, which you think is, the greater Orlando area. That's not a lot of homes times 4 weeks. That's only about 1,600 homes that are being sold on a monthly basis with a community that's well over 1 million people. Not a lot of homes. Then we look at our average days on market. We did come down a little bit. And then you look at our inventory after, really staying flat since January. We finally took a little bit more jump up. And I expect this to continue over the next couple months because we are going into the springtime when people, tend to sell their homes, that's the time people want to start looking at moving. Then we get into the condo market. And again, you see here the condos, original to final list, you're getting about a $12,000 discount overall. And look at this again, where's the biggest decreases? It's in the 250,000 below in condos. They're going for roughly 88% of their original list price. Again, same story, different day, in that they're having to adjust for the inflated HOA prices. And I'm starting to see, I expect this number to get a little bit closer for one simple reason, is the original list price that you're seeing on a lot of these condos, especially under the $250,000 mark, they're starting to decrease. They're about $10,000 to $15,000 below where they were in January. So I think we're going to continue to see downward pressure on the overall starting list price on a lot of condos in the Orlando area. And that's where we are this week with Orlando. Thanks for joining me, and we'll see you again next week. Any questions, always feel free to reach out to us. You can reach me directly, 407-710-8720. Please like, subscribe, and send us any questions that you have. We're always willing to answer. Have a wonderful day.